Directors' loan accounts. I want to just talk about directors' loan accounts, what a director's loan account is, why they arise, and why they can be a little bit problematic. I do regular updates on tax and accounting issues, so if you'd like to subscribe to the channel, you'll be very welcome. And if you press the like button, it helps me in the channel. So what is a director's loan account? A director's loan account is where either the company owes the director money or the director owes the company money. So it can be either way. So normally the way we talk about it is if the director is owed money by the company, then it's in credit and it's just a director's loan. But if the director owes the company money, then we say it's an overdrawn director's loan account. And it's very much like an overdraft at the bank, because if you've got an overdraft at the bank, then you've taken out more than is in there in the first place, and you owe the bank money. So similarly, an overdrawn director's loan account is where you owe the company money. So why do they arise? So in the first instance, it's very normal for the initial funding of the business to be from the directors. So normally the directors will fund the business with a few £1,000s, and that creates a director's loan account at that point. And when it sits there, it's basically money that you put into the company, so you can take it out of the company, and there's no tax consequence of taking it out of the company. It's just money that you've put in. That's relatively simple. So why is there a problem? Well, the problem is that for disciplined businesses, it's not so much of a problem. But if for a lot of small businesses, the business bank account and the personal bank account get confused. So personal expenses, I'm not recommending this, quite the opposite, but personal expenses are sometimes paid by the business, and it can be a little bit the margin between what is personal and what is business sometimes gets a little confused, and that can create a director's loan account, because if you've paid for personal things through the company, then that can create an overdrawn director's loan account, or it reduces your credit balance in your loan account. So how does it get refilled? Well, it can get refilled if you don't take your salary in cash, so that goes then to your director's loan account. We can pay, if there's enough, if the company's made profits, then it'll have reserves, and from those reserves a dividend can be paid. So your dividend can be cash, which is the recommended normal way of doing it. But if you've got an overdrawn director's loan account, then a dividend can be paid into the director's loan account, all by journal entry. So it's just accounting entries. So we pay a dividend as an accounting entry. The dividend gets posted to the director's loan account as an accounting entry. That gives, because the director has not received a cash dividend, he's put it into his director's loan account. He pays his personal tax on it at the point the dividend is paid. It's paid into director's loan account, and that can clear a director's loan account if personal expenses have been put into it, or if drawings have been made that were not covered by a dividend. So now, just to be clear, when I say a drawing is money. Normally what we say is when the director takes money out of the company, he's drawing it from the company, and that would be a drawing. Now that drawing could just be a dividend, so you declare a dividend, you draw it out, but sometimes directors just, if they're short of money, they just draw money out of the company, and then the accountants need to come in and make sure that the dividend has been made, and then post the dividend to the director's loan account, clearing through the drawings. And that's really how a director's loan account works. It's to make, and it's a mechanism, it's really in a bit of an accounting mechanism to make sure that the money that you've taken out of the company, the directors are taken out of the company to make sure that the dividends have been paid and that the tax treatment of the money taken out all balances out, so that money taken out of the company has gone through your tax return as a dividend or as a salary, so that the whole thing has been done correctly from a tax, and the HMRC would be happy with it. So there we are, directors' loan accounts. They can be used. It is better if you take regular amounts out of the company, you declare the regular dividends, you pay, you have salary, and you take the salary out of the business. But I know that that's not in practice how a lot of companies actually use their money. So if it's not done in such a disciplined way, we create directors' loan accounts, and then we make sure that the overall tax treatment is correct by using this director's loan account. I hope that clears it up. If you've got any questions, then please speak to me or one of the team. If you would like more updates on tax and accounting issues, then please subscribe to the channel. And if you found the video useful, then please press the like button. Thank you.